Welcome back, YouTube, to our Capital. Today we're going to be going over our Options Day Trading Mentorship Class 4. We're going to be going over technical analysis fundamentals, things such as support, resistance, trend lines, volume spikes, and how we can use multiple time frame analysis to be able to differentiate high probable setups from the low ones. Let's get started here. What is technical analysis? Technical analysis is the study of price charts and patterns to predict future price movements. What we analyze: price movement patterns, support and resistance levels, volume trends, chart patterns. Why do they work? Price reflects all information, history tends to repeat, traders act on patterns, self-fulfilling prophecy. So guys, if you've seen history repeat itself, whether it's at a psychological level, let's say you're trading a stock like Nvidia and you see that every time we come up to 190, we seem to have some trouble, what can you expect the next time that you go to 190? You're going to expect some sort of resistance. You can either use very specific levels or you can use areas or zones. The areas or zones are going to give you a better entry on these trades just because sometimes you don't come to the resistance. It could be 10 cents off, 20 cents off, sometimes even $1 off. So if you tend to use them more like zones, be more probable at catching a trade, whether you're catching a trade based off a rejection of a resistance or a bounce from a support. So core belief: everything you need to know about the stock is visible on the chart. You can use price action alone, no indicators involved, to tell you whether a stock is strong or weak. That's what we're going to go over today. Price action versus indicators. Price action, what is it? Raw price movement on the chart. Advantages: real time, no lag, most reliable signal, shows true supply and demand. You're not using an indicator to try to tell you where the supply and the demand is. You can visually see it on the screen by how the candles are forming. Our primary tool: price never lies. We're always updating you guys where price is at, especially close to these psychological levels or levels of support and resistance. We're constantly updating you guys in our live trading sessions, telling you where these stocks are trading in correlation to these levels. Why? Because we can see opportunity based off of these things, whether it's an opportunity to get out of a trade or just looking for a reversal trade. Indicators, what are they? Mathematical calculations based on price. Purpose: confirms price action, identifies momentum, spots divergence. So you guys always see in the live trading calls that we're also updating you guys on where price is relative to our indicators, whether that's the VWAP bands, using the middle VWAP band as a dynamic support and resistance, or using our arc clouds to be able to tell if we are in an uptrend or a downtrend and if there is the volume and momentum to back that trade up. The further the clouds are spread out, the more of a move in a certain direction you have. So we're using not only price action, but we're also using indicators to be able to get into these trades. They work hand in hand, and you use the indicators as a confirmation tool. Drawing support lines properly, step by step drawing support. So if you've ever sat there and asked yourself, how can I identify these levels of support or these levels of resistance? This is how you do it, guys. This is the step-by-step guide on how to find levels of support. So step number 1, find the lows. Look for at least 2 to 3 points where prices bounced up from on the same level. Step 2, connect the dots. Draw a horizontal line connecting these low points. This is going to visually help you see where these levels of support are. Step 3, using the bodies. Draw each line through the candle bodies, not the wicks. It gives you a more accurate representation of where the trend is being held and where it's being rejected. We focus very much on the candle closes here at our Capital. Step number 4, extend forward. Extend the line into the future. This is your support zone. Pro tip: support is a zone, not an exact price. Allow for some wiggle room. Before we continue, is everything making sense so far, guys? Pretty simple stuff here, just going over the basics, telling you guys what price action is, telling you guys what indicators are, telling you guys how to find support levels. If we all take a look at the chart here, what are we looking at? We are looking at coin on the 1 week. So each one of these candles represents 1 week of time. we have this level here at 145.20. You can consider it a zone anywhere from 146 to 144. Give yourself $2 of room. But if we go to the exact level here, we are looking at 145.20. What can we tell has happened with price every time we've came down here? If you guys take a look right here, September 6th, 2024, price came to this level, rejected off of it, using it as a support, bouncing back to the upside. What happened once again here on the 11th, 25, price came back down here, respected it as a support, and bounced back upwards. What happened just 2 days ago, guys? What happened on the 13th? Price came back down to these levels, respected it as a support, and bounced back up. What is this showing you guys? What did we just go over? This is a level of what, guys? A level of support or a level of resistance? Let me know. Talk to me, guys. I see Benji already answering. He's locked in. There's a reason why he's able to do this technical analysis. Here we are looking at a level of support. You're typically looking for these levels on a higher time frame. As you can see here, we are looking at a 1 week chart for the levels of resistance, step by step drawing resistance lines. So it's the same exact logic that we just applied just for the upside, guys. So instead of looking for where the floor is at on the stock, when you're looking for a resistance, you're looking for a ceiling. If you guys remember, in class, I'm pretty sure it was class 2 or class 3, that we mentioned the elevator analogy, where if you're trading or the price is trading below the level, you use that level as a ceiling or a level of resistance. Once you break above that level of resistance, that previous ceiling becomes a floor, right? In turn, becoming a level of support. Here is the step-by-step to drawing resistances. So step number 1 is finding the highs. Look for at least 2 to 3 points where price is rejected down from the same level. Step number 2, connect the peaks. Draw a horizontal line connecting these points. Step number 3, bodies over wick. Focus on where the candle bodies got rejected, not just the wicks. Step number 4, mark the zone. The line represents your resistance zone moving forward. Remember, the more times a level is tested, the more significant it becomes. We're always keeping our eyes on these levels of support and resistance, whether it's a psychological level, whether it's a gap level, whether it's a fib level. As long as price is trading below it, you use that as a level of resistance. Let me flip over to our charts here so I can give you guys a very clear indication of a level of resistance. What are we looking at here, guys? Today, we are using NVIDIA on the 1 day chart. So every single one of these candlesticks represents 1 day of time. Previously, we drew our level of support on a weekly level. This time, we are drawing our level of resistance on a daily chart. This just goes to show you guys that looking at different time frames is important, especially when marking out these levels of support and resistance. Sometimes you'll see something on a weekly time frame that you may not see on a daily, vice versa. So what level do we have marked out here, guys? We're trading here NVIDIA on the 1 day chart, and we have our level right around 193.28 marked out. Once again, you want to use it like a zone. You can say anywhere from 190 to 194, giving yourself $2 or $4 of range to the upside and downside. So what can we see that price has done every time we've come to this level? Right here, you have our first rejection. You have times where we have broken through this level using it as support, but you can see that every time we came down and tested it, it came back to be a resistance. Once again, right here, rejected. So there's multiple points on the daily time frame where 190 has rejected this 190 area. So what is this telling you guys? This is a level of resistance. Every time prices came up to this level, since history repeats itself, there is going to be some sort of struggle at this level. Is everyone picking up what I'm putting down? Let me know in the chat, guys. Let me know. Type a 1 in the chat if I'm going at a reasonable speed. If you guys understand what I'm going over. I hear my boy Richie Rich. Hello. It looks like everyone understands. So we already went over how to draw support levels. We already went over how to draw resistance levels. We went over the difference between technical analysis and our indicators. If we switch back and go back to our slides here, Support and resistance drawing best practices. So this is going to be what you guys can use as a determination whether it is a level of support or a level of resistance and how to do it proficiently. So this is what you're going to do for your best practices. Draw on the higher time frames first. So you're going to be looking at the daily 1 hour time frame. You're going to use candle bodies, not wicks. You're going to look for multiple touches, whether that's 2, 3, 4, 5 touches. Remember, every time that a level gets tested, that level becomes more significant. Draw as zones, not exact lines. Remember, guys, you want to give yourself a little wiggle room when drawing these levels or zones. Stocks don't always come and touch the level right to the point. Sometimes it does, right? But not always. Last one here, keep your chart clean, guys. Only keep the levels that are most important. I have fallen victim to this where I have drawn out multiple gap levels or just psychological levels or just levels on a chart, and I've traded them. And let's say I'm looking at a stock for 5 months, 6 months. By the time that time goes by, if we're trading in a range, the price action is barely even visible because of how many lines you have on your chart. Rich and I were literally talking about this earlier on stream today. Someone sent their chart and it looked very overstimulating. It looked like unnecessary. It may work for some people, but at the end of the day, if you're a beginner, the last thing you want to do is confuse yourself and draw a line and not know where the heck that line came from. So, what not to do? Draw lines based off of one touch. If you see a stock only touch one time, you cannot consider that a level of resistance. You need to have previous history backing up your claim. So force lines where they don't fit. The last thing you want to do is also just to put lines. That's not a level, right? You need to be calculated when drawing these levels. So make sure that the rejections or bounces are clear. Draw too many lines equals clutter. Just what we went over. That's the last thing you want to do. You want to keep your chart clean, right? Ignore higher time frame levels. You don't want to ignore them. Higher time frames are always going to tell you the bigger story. So if you can find a level of support or resistance on a higher time frame, that's going to hold more power in the long run. Especially if you're day trading and you see us come to one of these levels, it's not something to ignore. A lot of stocks today came to very significant levels. Let's say for Nvidia, we were trading below 180 for a little, but we know that 190 is a strong psychological level. What ended up happening? Nvidia held 190 and bounced up 5, 6, 7 points, right? What happened with AMD? We were trading around the 200 psychological level, trading below it for a little, but eventually breaking back above.
So look at how many times since we gapped over this 200 area, every time that we've came back down to what the low is 190.89, 190.90, right? So let's just say that the 200, 190 area, it's a very big area where buyers are sitting. And a lot of people who are positioned are in that level. And every time we come to this level, buyers are holding this, right? So even today, we see how this candle closed. At one point, we were all the way down at 194. And we closed sitting right at 203. So that's a $9 move up. $9 price swing intraday for us as options traders. This is a very nice move if you're playing short term, but even just looking at it from a bigger perspective and looking at it from a daily chart, we know that let's say the market is strong tomorrow, we're at this very critical support. If QQQ is strong tomorrow, we're likely going to bounce and potentially have a big bounce from this 200 area, right? Potentially to 215, maybe that 215 area where we rejected from previously. And that's a $15 move. If you can catch a $15 move on the options, you can, that's like what, a 300% or 400% on AMD. So there's opportunity, right? There's some opportunity on it, and that's a very good example of a strong support. You have a gap down underneath, but the price is really respecting it. Very respecting the gap, holding that 200 psych level, and very clean established support.
100%. Beautiful. Also, even on Tesla today, we saw that we used that 400 level as a level of support. How many times have we seen Tesla come down to 400, and by the end of the day, it's trading back above it? So, the golden rule, less is more. Only draw the most obvious and important levels. The last thing you want, once again, is clutter on your screen. You don't want to confuse yourself as a beginner. Trend lines are diagonal lines that connect highs and lows of price action to show the direction and the strength of a trend. If you guys remember, In class 2, we went over higher highs, higher lows, how to identify an uptrend, how to identify a downtrend. Trend lines are simply connecting these higher highs and higher lows, or lower lows and lower highs, and visually seeing where the trend is headed. Uptrend lines, how to draw, connect the rising lows or the higher lows. What it shows, support level in an uptrend. Buyers keep stepping in higher. So every time you see price come back down, you can expect a leg up higher. When you're drawing downtrend lines, how to draw these is connecting the falling highs or the lower highs. Same thing. What it shows, resistance level in a downtrend. Sellers keep pushing price down. So anytime that it comes to a trend line, you can see that the sellers are stepping up. Right? What's the purpose of this? Trend lines help you see a trend's direction and identifying potential reversal points. So if you know where a stock is going to react, you can use that to your advantage, waiting for confirmation on these trades. So if we flip over back to our charts here,
If you look right here at this 4-week daily time frame, let me pull it up on my screen. Give me 1 second. Let me pull it up on my thing. All right, if we look at this daily, very clear higher time frame wedge, right? Little bull flag setup. I'm gonna call it a wedge, right? So if you hear me say that term wedge, it's just a wedge is trading between the trend lines in a little down channel. So every time we come up to this top of this trend line, when we came up at 146, right? We reject, price comes all the way back down to the bottom of the trend line, which just so happens to be at this 66 area, and then starts to bounce, obviously catch some support. And when it's pushing back up, where are you going to target? If you're going long and the price is in this wedge and you draw these trend lines, you know that when price starts to trade around these trend lines, I should look to get out if I'm long, or potentially take a short position if I believe it's going to reject it and come back down into it if it's not ready to break out yet. So on this case, it looks a lot cleaner on a, let's say, a weekly time frame or even a monthly time frame. The daily, it looks just like a down channel that you can trade it, right? You could play calls at the bottom of the channel and go short at the top of the channel, right? And when it's trading in between the channel we are on the daily, not really much to do until we break out of this shorter term pivots, right? And our shorter term pivots is this 100 psych level. And our first target would likely be that previous 150, 110, 115 area. And just so happens to line up with that top of that wedge, right? The top of that trend line is sitting right at that 110 area. And we know 110 is a very strong support. So
going back to what the slide was saying for a downtrend, we're technically just marking out the lower lows, right, and the higher lows. So if you guys just had point this one right here and we couldn't see price action yet, like Rich said, you can anticipate price coming back to this line right here, which we've seen it did perfectly, and reject off of that. So it's just a very clear indication of how to use these trend lines and how to mark these out.
There are people's strategies where they only buy against these trend lines. And let's say they're going short against these trend lines, right? There are only people who really get into these trades when price is trading. If you go down and you see one of those wicks off of the trend line on CoreWeave, yeah, right over there. There are people who they would see that and they would just buy, let's say, long dated calls, a bullish position, or some other kind of option spread, and play it either directionally or through a spread or something like that, right? But they'll buy time on it just against the trend line. And even if you look, when it popped back up to that 100 area, just off that, they would have been in some very nice profits, right? Put your stop loss close under the trend line, and you have a clean trade. It's not really the strategy that we go off of, but some people do, right? How we look at it, this is where a base of support is forming, right? We know that last time the price hit this trend line, it bounced the next day, right? So this is, we can use it to help us anticipate things, right? And for further anticipate things. Yes, I feel like that's the best way to put it.
100%. How to draw trend lines properly. The proper way. Identify the trend. Make sure that there's a clear trend, higher lows or lower highs. Remember, guys, going back, referring to class 2, being able to identify these trends are crucial, especially on the higher time frames. Step number 2, find 2 strong points. Connect at least 2 clear swing lows in an uptrend or swing highs in a downtrend. We just showed you guys how to do that on a downtrend, right? 3, don't force it. If the line doesn't touch multiple times naturally, it is not a valid trend line, right? Don't try to make stuff up. Don't try to go based off of what the chart is showing you guys. That's going to give you the most valid pivot points, right? So validate with third touch. A trend line becomes highly reliable after price respects it a third time. What makes a valid trend line? Connects at least 2 to 3 swing points. Draw using candle bodies, not wicks. Respect the line on multiple touches. Aligns with overall trend direction. If you, let's say you draw a trend line and it checks off every single one of these marks, you have a valid trend line. Trading trend lines. How to trade with trend lines. Bounce strategy. Trade in the direction of the trend when price bounces off a trend line. For an uptrend, you're going to buy calls when price bounces off uptrend line. So when we come to that pivot point where we've seen price come in respect, where the buyers come in, right? That's where some people base their strategy off of this, where it comes to test the trend line, right? For a downtrend, you would buy puts when price bounces off a downtrend line, right? Break strategy. We love breakout trades, right, guys? How many times have you guys seen Rich hop on for pre-market analysis or a Sunday preparation class and he pops up his charts and we're trading a breakout? It's happened so many times. This is more our style. Once we see confirmation of a trend break, we love to play this because we know how much momentum and how much volume comes after the confirmation. So the break strategy is trade the reversal when price breaks through a trend line with volume. So an uptrend break is possible reversal, consider puts. Downtrend break, possible reversal, consider calls. Warning, always wait for confirmation. A single candle breaking through the trend is not enough. You always want to wait for that break and retest. If you get the retest and it uses that previous trend line of support, if it uses it as resistance, right, you are going to use that as a valid entry setup. So let's go next here. Volume as a confirmation tool. Volume is your confirmation tool. It tells you if price has real strength or if it is likely to fail. How to use volume for confirmation. Strong moves equal high volume. Big price move plus big volume equals real move likely to continue. Weak move equals low volume, right? Big price move but low volume equals a suspect move likely to reverse. Volume confirms volume. Breakout plus low volume equals likely false. We've gone over this in class before, guys, showing you guys how anytime that we come to test, let's say middle VWAP or the cloud, when you see that volume in the opposite direction start to slow up, you can tell that that move back to the downside where the trend is being tested is not going to hold up, right? It's going to bounce back up in the direction of the trend. We've shown you guys this with the volume candles slowly coming down in our previous classes. I'm pretty sure you guys understand this. Everyone has attended these classes before. So simple rule, never take a breakout trade without checking volume first. Right? How many times have we been live trading and we're looking for volume confirmation before getting into the trade? It's just one of our trademarks here at Arc Capital. So volume spikes and what they mean. What is a volume spike? A volume spike is when the volume bar is significantly taller than average, indicating major trading activity. What a volume spike tells you. Spike on a green candle shows you that there's strong buying pressure, right? Bulls are in control, likely to continue up. Spike on a red candle, strong selling pressure. Bears are in control, likely to continue down. When you guys see these spikes in volume, don't ignore them. These can be potential trade setups that are accumulating, right? Let's say you have a big volume spike and you're also coming to a level of support or resistance, or let's say that you're coming to a trend line, right? You can use these technical analysis, just fundamentals, to be able to guide your trade, right? So a spike at a support or resistance, major battle between buyers and sellers, watch for the winner, right? Watching for the winner and waiting for that confirmation will allow you to be able to take these pivot trades or these bounce trades or these rejection trades, right? So spike after a long trend equals possible exhaustion, right? The trend may be ending, right? Climax volume. They're giving it that last push, especially when you see a stock super overextended and let's say you see the selling volume start to push in and it's a big selling volume spike. You can expect price to come down back to that trend test, right? So let's continue here. Reading volume patterns. Healthy uptrend volume. Higher volume on the green candles, lower volume on the red candles, right? Anytime that we're trading, let's say SPY, Tesla, NVIDIA, all the individual names, indexes, anytime that we're trading these, we're going based off of where the momentum is and where the trend is, right? If we're trading in an uptrend, you're looking for the tests of the cloud or the middle VWAP. So you're looking for higher volume on the green candles, right? So anytime that the chart is going up in the direction that it's already claimed, you're looking for more volume on those. And anytime that we get a pullback to the trend, if you want the confirmation, you want to see lower volume on the red candles, right? Volume increasing on the rallies. So on the way up, you'll slowly see the buying volume be bigger in each candle, showing you that the trend or the direction that the stock has already chosen is going to continue, right? Volume decreases on the pullbacks. This shows you guys a strong uptrend, right? So vice versa, what are you looking for a healthy downtrend volume? So you're looking for high volume on the red candles, low volume on the green candles, volume increasing on sell-offs.
Yo, you good? Yo, we lost him. Chat, you guys hear Angel?
Sorry, guys. Sorry. My mic disconnected. All right. Where was I? All right. Volume increases on sell-offs. Volume decreases on bounces. Strong. All this equals a strong downtrend, right? Same logic that we use for an uptrend, guys. Anytime that you see that price starts to bounce back up towards the cloud or the VWAP, you're going to see less and less buying volume, right? It's the same exact kind of concept that we were using just for a downtrend, right? So warning signs, divergence. What is divergence, guys? It's just when two stocks or two indices are doing the opposite things. If this is a game of probability, guys, you want everything to be doing the same thing. That's going to give you the highest probability, correct? So warning signs, divergence, price going up plus volume going down, right? This equals a weak uptrend likely to reverse, right? Price down, volume going up equals a strong downtrend may reverse soon, right? So what I was talking about was divergence between stocks, but what this is talking about right here is divergence between the price action that you're seeing, so the candlesticks on the chart, and the volume bars at the bottom of the chart. So if these two things are telling you the opposite thing, let's say you're seeing big green candlesticks every time we go up, but it's small buying volume on the bottom bar, this is indicating to you guys a weak or a fake move, right? This is how you can catch yourself from taking false breakout trades, right? Or just fake outs, right? So key insight, volume should confirm the direction. If it doesn't, be cautious, right? You want to take it here, Rich?
Let's do it. So reading divergence between indexes. So what are index divergences? Do you guys know? Does anybody in the chat know?
Talk to us.
Anybody
Does anyone know what index divergences are?
He said SPY IWM. Yo, Ivan, I love you, brother.
Fuego, there we go.
It's Fuego. Nice. Good answer. It's when the Qs and the SPY go opposite directions from each other, right? Let's say the tech market, QQQ, having a very good day, right? All the tech stocks are ripping, NVIDIA, AMD, all those stocks are going up. Microsoft, all of them are performing very well. Well, Microsoft is down, but SPY is down on the day and trading either choppy or in a downtrend, right? There's a divergence there. Why? Because QQQ is going up and SPY is going down, right? So divergence is essentially just a fancy way of saying doing the opposite of each other, right? Moving in different directions. What do we watch for? So how we trade, we are very directional traders, right? Very directional traders, which means we thrive in a market that is directional. We thrive in a market that is giving us consistent trends, right? Price is moving up, bull flagging, continue to move up. Price is moving down, bear flagging, and then continuing to move down. Not choppy moves, right? Not range trading. We could do good in a range. We've been killing it on SPY lately, doing amazing. But we thrive in a very directional market, and we've been having these directional days these last 2 weeks, where one day will be heavy direction, right? You can make a lot of money on days like that, especially if you're trading shorter term expiration contracts, or if you're trading futures, you can make a lot of money trading that. And when you see SPY and QQQ moving together, right? When you see the overall market moving in correlation and everything is moving together, SPY and QQQ are both moving in the same direction together. It is much safer to trade with the trend. I'll feel very confident to hold calls if the markets can both going up. SPY and QQ are both going up. I'll be very comfortable to hold calls, and vice versa. Both the markets are selling off and continuing lower. I'll feel very confident to hold puts and to short. So now when SPY is going up and QQQ is going down or vice versa, there's market uncertainty, right? You want to be more cautious in your trading, right? You want to be a lot more risk off and not as heavy, right? If you, let's say your position size is 10 to 20 contracts, when there's a lot of divergence in the market and the market's very shaky and uncertain, you want to maybe go 5 contracts. And if your normal position size is 3 contracts, then maybe you want to go 1, right? When one index breaks down first, it's got warning sign that others may follow. So you always want to look out for that, especially let's say in the morning. This is a good scenario. Let's say in the morning, if QQQ in the Nasdaq is going up, having a nice morning first 30 minutes just pumping, pushing up, and SPY on the other hand is either ranging or stuck underneath VWAP and pushing lowers, sitting at low day, maybe even pushing down. You could anticipate if SPY is weak and QQQ is slightly stronger right now, maybe this is just a morning amateur move. That's what we call it, the amateur move in the first 30 minutes. And then 10 o'clock and 11 o'clock, everything continues to sell off and become directional, right? Continuing down. Your warning sign in that case is SPY in the morning, either sitting at low day or pushing lower or just remaining choppy while one index is trying to be directional. So now it's a lot more easier to spot in the morning and intraday than explain it right now. That's why you guys come on the live calls. So an example of this is SPY making higher highs, but QQQ is making lower highs. There's a divergence. Tech is weak, and there's potential market uncertainty, right? So if you see that unwinding in tech midday, then you can anticipate SPY coming down because SPY does have a lot of tech heavy names in SPY. So when you see selling in heavy selling in the Nasdaq, you likely most of the time you also see that heavy selling in the SPY, right? Maybe small caps, IWM or DIA is strong, but let's go on to the next slide. So why index divergences matter for day trading, right? The market is a system. When all parts move together, it's healthy. When parts move differently, you got to look at it like there's a potential trouble ahead, right? When things are moving differently, you have to be a little more cautious, especially if you're trading directionally, right? If you're looking for calls and like I said, QQ is moving up and SPY is moving down, there's a clear divergence. You have to be very cautious with what you're doing, right? The confirmation signal is all indexes trending the same way. When you see all the indexes trending the same way, that's when you get aggressive. That's when you up the size, and that's when you really lock in, right? You hold your winners longer. If your play starts to work out immediately, you want to hold as much of your contracts as you can for as long as you can. And frankly, that's what the art clouds do, right? They help you hold these trades a lot longer, right? You can essentially you following the trend super confidently with ease. And it's a lot easier said than done because when you're in a trade and it's working, the first thing that you're thinking about is trying to get out. Oh, I need to get out. I need to take it. But sometimes you need to just sit back and let it work. That's how you're going to grow your account. So our confirmation signal is really when we see all indexes moving the same way, we see the individual names with clear strength that we could spot, right? That's when we get aggressive. The warning signals are when we want to go cautious in the market, we want to go light, is when indexes are moving in different directions. And lately, the market's been moving very weird in the morning, right? Very sporadic the first 30, 45 minutes of the market. First hour, to be honest. When you see these indexes moving in different directions, what to do? You reduce your position sizes. You take profits quicker when you are in a market like this that's very choppy and range bound because we have these aggressive moves down, followed by aggressive pops back up, followed by aggressive moves back down. So if you get caught on one of those wrong sides, it could hurt you for sure. You got to expect the choppiness when you see divergence like this. The pro habit is going to be checking SPY and QQQ every morning before trading, and if they're aligned or are they diverging. And if they're diverging, then you might want to either step away. If that's not the market that you want to trade in, you step away and you be disciplined and you go away. And if they're aligned, then you look for your opportunity in your basket of stocks and you attack. Right? You get a little aggressive, you get a little weird. You get what I'm saying? All right, the next slide here, we got multiple time frame awareness, right? Why do we want to check multiple time frames? Each time frame tells a different part of the story. You need to see the bigger picture and the details. Now, the details are going to be your smaller time frames, 10-minute, 5-minute, 2-minute, right? The 3 time frame rule, higher time frame. Daily 4 hour, I threw the weekly in there, weekly, daily 4 hour. The medium time frame, your 1 hour, your 30-minute, and you got your lower time frame. And in my opinion, your lower time frame is going to be that 15, 10, 5-minute to your 1 minute time frame. Now, ideally, I don't really go on the 1 minute too much. Maybe the 2-minute, 3-minute here and there. But the 5-minute and the 10-minute are the real bread and butter where you're going to find your best entries. Let's get to the other slide. How to use multiple time frames in day trading. The top-down approach. Very simple. You start big and you go small to find your entry. So starting big just means you check your daily chart, right? Is the stock in an uptrend or downtrend? Where are the major support and resistance levels, right? Are we sitting at a major support? Are we right under a major resistance? That's what we're looking for. How to spot those, like Angel was talking about before, you look at the wicks and how price reacted at these previous zones before. Did it sell off? Did it reject? Did it bounce? Did it hold? Did it rip? How did it react previously, right? That's what you're looking for. Check the 1 hour or the 15-minute chart. Really, the 1 hour or the 30-minute chart, I'm going to say, to find your potential entry zones, support in uptrend and resistances in downtrends, right? You're going to look for the supports in a downtrend on the hourly or the 30-minute time frame. And if you can time those right, you can potentially catch a very nice move, and vice versa on the downside as well. And how we trade, we really do watch the 10-minute all day. So we check the 10-minute chart, wait for price to come into our zone. Now, when we're day trading, our zone sometimes changes all day if we're using the cloud. If we're in a directional market, anytime anything is, let's say, moving up together, all indexes are moving up, individual names are moving up, and let's say that you're taking a trade and it's coming to your EMA clouds, it's always a buy, right? That's entry criteria right there. And your stop is going to be a close under the cloud, or if you want to get weird with it, a close under the 34 and the 50 EMA cloud, which is a little further underneath, right? Yeah, so you'd wait for your price to come to those zones in the 10-minute chart. You look for your entry, which is a bounce at the cloud or a rejection at the cloud if you're looking for a downside, if the price is in a downtrend. Or let's say price is breaking out and it's consolidating right underneath the breakout level and it's holding the cloud. If the price is sitting right under that breakout level, holding the cloud in an uptrend, very good sign. That's an entry, right? That's when you execute your trade. You enter with confidence, knowing all time frames are aligned. You enter with confidence, knowing that where your stop loss is under the cloud. If it's a close under the cloud, listen, things sometimes get those sporadic drawdown. Boom, goes down $1 real quick, $2 on you real quick. And if you don't let that candle close, you can get shaken out real quick. And then the moment you sell, boom, back up $2, back up $1, whatever it is. It's happened to everybody in here. I know it. It's happened to me plenty of times. Right? It used to happen to me before I used the clouds, the ARC clouds. We got to call them the ARC clouds now. I started using the clouds, I'd say about 4 years ago. Before that, I was just using regular EMAs, and the regular EMAs are cool, but they're just a little too much on the chart. I like to think of things as zones instead of exact little levels, because I used to think of everything. It has to come to this exact EMA, and if it doesn't, I can't get in. And then I miss out really good moves because I missed it by 50 cents. So I like to use it in how it has the cloud approach, right? Once it gets into that zone, it's very nice. Let's get to the other slide here. The power of time frame alignment. The best setup is always going to be when all time frames are aligning and agreeing, right? All time frames are telling you the upside is going to happen, or if downside is going to happen, right? If price is making lower lows on higher time frames on the daily and in a bearish sentiment or whatever it is, it could be used both ways, right? All time frames have to tell you the same story. Perfect example is the daily chart is in a strong uptrend with higher highs and higher lows. 1 hour chart pulled back to a support level, which is the higher low on the daily time frame. It's a buying opportunity because the previous higher low, price bounced right back up to make a higher high. The 10-minute chart, price bouncing off support with green candles in volume and ideally the cloud. Now that equals a high probability trade, right? Now the warning is if time frames conflict, then wait. You don't want to force trades when the story is not clear, right? If everything is telling you the same thing, high probability trade. Now it takes you really 2 minutes to look at all the time frames, maybe 3 minutes to look at all the time frames really fast intraday if you're really trying to get into a play. Boom, analyze quick. If you have that eye, sometimes five. Let's say it takes 5 minutes to look at all those time frames. If you're behind the computer, if you're at work, different story. If you're behind the computer, it takes you 5 minutes max to look at the daily, hourly, 30-minute, and 10-minute to look at if you think something's strong. How has it been recently? Whatever, right? Your trade's not going to leave you in those 5 minutes, and unless you're maybe trading zero DTE, right? If you're trading a next week or even a weekly, right? It's not likely. There's a 90% chance it's going to still be there with after those 5 minutes are done, or you're maybe going to get a better entry because you're not rushing it because you have to take the time to look at all the charts. Now, if the weekly is super overextended, but we're at a nice point of support on the daily and hourly and everything, that's still acceptable. But now let's say if the daily is showing you a complete bearish trend, the hourly showing you a bullish trend, the 10-minute showing you a bullish trend, then it's just a low probability because it's all over the place, right? You're looking for a long trade in a bearish sentiment, right? You don't, when the stories are not lining up and they're not clear to each other, it's not something that's going to be probable and not something that you're going to want to take. Let's get to the next slide. What to do when time frames conflict each other. So now conflicting time frames could be a danger zone. Now, what do I mean by that? When time frames tell different stories, the market is undecided and the market is uncertain. And when the market is uncertain, likely a lot of the time things end up selling off or just staying flat, and you can get burned if you're playing short term, something short term. Common conflicts are the daily's in an uptrend, the 1 hour's in a downtrend. You wait for the 1 hour to align with the daily, or you skip the trade. If the 1 hour is in a downtrend while the if the hourly time frame is in a downtrend while the daily time frame is in an uptrend, wait for the hourly to flip into an uptrend and then look for the trade. And if not, just skip it. It's very simple. Don't overcomplicate it. Don't blow yourself up. If the 1 hour is breaking out and the 10-minute is rejecting, it's likely a false breakout. Don't chase it. Wait for the confirmation. Wait for candles close. Especially in the morning. The candle closes at 10 o'clock. Wait for that first 30 minutes. Look at how that hourly candle closed. The 15-minute looks like a support bounce. The 10-minute is breaking down. Support may not hold. Reduce size or wait for the clarity. Right? The solution in this is when in doubt, sit it out, baby. When in doubt, sit it out, man. When in doubt, sit it out. It's never, listen, missing a trade is better than losing money. Missing trade is better than a red trade, right? Wait for the alignment or find a different setup. There's, guys, always another trade. Let's get to the next slide here. Do you want to go over this?
For sure. Let me do it here. All right, so putting technical analysis together, guys. This is your pre-trade checklist. So everything that you're looking on the fundamental analysis side, right? So for the chart setup, you're looking for support and resistance levels to be marked clearly, right? Trend lines drawn properly, volume bars visible, multiple time frames checked. If you have all these things, right? If you have your clear resistances, clear supports, your trend lines, your volume bars are visible, and your multiple time frames are checked, you are going to be more prepared to take a structured trade, right? You're going to have more confidence to hold the trade. Why? Because you understand what's going on in the market, guys, right? Being able to identify that we're in an uptrend is one thing, but knowing that if we're at a pivot point, knowing where price is going to bounce, that's a whole other thing. That's going to give you more confidence knowing that history repeats itself, knowing that you're buying in a place of interest, and knowing that you're using your volume candles as confirmation tools, right? All these things together are going to help you guys take better trades, right? So what are the trade confirmations? Price action supports the direction. Volume confirms the move. All time frames are aligned, and indexes are not diverging. Remember, guys, we are playing a game of probability. So if everything is telling us the same thing, if everything is giving us the green light, you are taking a high probable trade. That's what we're looking for here. We're looking for a more structured approach using technical analysis aligned with our indicators, right? Using both of these and using all of these, using this checklist is going to give your trading more structure. You're going to feel like you have more confidence in entering these trades. A lot of people sometimes get analysis paralysis, and I feel like that leads to maybe having too much clutter, right? If you have your clear support and resistances marked out and only those clear ones, you're going to have a lot better results, right? So the perfect setup has clear trend direction, price at support and resistance levels, volume confirmation, multiple time frame alignment, no index divergence, clear price action, proper risk management, and clear invalidation points. Basically everything we just went over, guys. You just need to look at it like a checklist, right? If you're managing a business, right, you're going to check through all the requirements that you need for that business to run, right? If you have all the checklists required, or if you have everything on the checklist that's required, your business is going to run smooth, right? But let's say you miss out on some steps, some basic protocol, you can mess yourself up, right? So the last thing that you want to do is trade in the opposite of these, right? So if you have your index is diverging, let's say there's no clear price action, let's say there's no proper risk to reward, no volume confirmation, no clear trend, you're setting yourself up for disaster. So look for the perfect setups, right? Remember, not every setup will be perfect, but the more boxes that you check, the better your odds, right? Remember, guys, game of probability. So the more that you have these checked off, obviously, the better are your chances of having a high probable trade. So, key takeaways for class 4, guys. Technical analysis studies price charts to predict future moves, right? Price action is your primary tool. Indicators only confirm, right? You need to be able to identify what's happening on the chart without indicators before using indicators as a confirmation. We went over how to draw support and resistance lines using candle bodies, not wicks, connecting with 2 to 3 minimum touches. We went over trend lines, connecting rising lows in an uptrend or falling highs on a downtrend. We also went over volume confirms price moves. High volume equals strong move. Low volume equals weak move. We went over volume spikes and how they indicate major activity, paying attention at key levels, right? If you have a volume spike at a psychological level, it's something that you should keep your eye on, especially if we're in a clear trend, especially if the indexes are not diverging, right? If price action is clear, these are things to pay attention to, guys, right? So watch for divergence between SPY and QQQ. If everything is aligned, that equals a strong market, whether it's to the upside or to the downside, right? It's giving you that probability that whatever direction it is playing in, it is going to continue, right? Check multiple time frames. Check the daily for trend. Check the 1 hour for zones. Check the 10-minute for entry, guys. Very simple stuff, right? The best trades have all time frames aligned in the same direction. The more confluence that you can get when analyzing these markets, guys, between different time frames and even different stocks telling us the same thing, the more confidence that you will have when taking these trades, right? So when time frames conflict, wait for clarity or skip the trade. There's always going to be another trade, so you don't need to worry technically about missing out on a trade. Cash is a position at the end of the day, right? You can always play defensive because the market will always be there when you wake up tomorrow. Less is more. Only mark out the most obvious and important levels on your chart. This is going to help you guys from the clutter, and it's going to help you guys keeping your bias clear. If you have too many levels, you're going to be trading in between the levels, leading to you having more indecision when day trading the market. Right, guys? So this was class 4 for ARC Capital Options Trading Mentorship, Technical Analysis Fundamentals. I hope everyone enjoyed today. I know that this was a pretty beginner class here, but anyone learn anything new? Even if you're a little bit experienced, did anyone learn anything new? I know I have a couple beginners in here, and I know we have a couple of experienced traders here. We have 40 people here. Did anyone learn anything new? Great refresher for me. Of course, every class. Appreciate it. W. Hello. As you guys know, these classes will be posted on YouTube. As the weeks go by, we will have everything updated in our education center. Also remember, guys, we are closing off all the free stuff going into March. So all the free classes that we have been doing is going back to premium. So make sure to book those calls, guys, and make sure to lock yourself in for what we are doing here, because once these beginner classes are done, we're going to be going fully into how to actually maintain the habits that a profitable trader does on a weekly basis. With the charting classes that we're going to be doing, with the trade recaps that we're going to be doing, you're going to understand how you're going to journal your trades. You're going to get the pattern recognition that you need to identify your good trading habits, your bad trading habits week after week. And those charting classes are going to help you guys identify those levels of support, levels of resistance, the trend lines. If you're doing this on a week to week basis, you're just going to get better at it and being able to do it independently, right? So once these beginner classes are done and you understand all the basics of the market and you understand how our system works, it really comes down to applying those reps, right? Week after week, going over your trades at the end of the week, charting out new stocks, finding out information, how you can use this information to your advantage, knowing what trend we're trading in on the higher time frames. Little things like this is going to sculpt you into the trader or having the habits that you need to become a profitable trader. Right? It's going to be muscle memory. Yes, sir. You already know. Once again, we appreciate every single person for coming here, spending their time with us. Right now, we'll take a little bit of time to answer some questions before we go into our prayer here. So if anyone has any questions, let us know, whether it's for the mentorship, whether it's for anything that we went over in class today. We appreciate you guys. We'll give you guys a little bit here to type in there. Amazing class. Thank you. Always helpful.
Thank
Let's
you.
go. W's to you guys, right? You guys are the ones that
Same here.
understand this information and are still popping out at the end of the day. All 40 of you. W's in the chat for the chat. Hello. Chatting just to chat. All right. It doesn't look like anyone has any questions here. I just see a bunch of W's. If anything, I'll get right into prayer, guys. Hello. Yep. No worries. Let's do a little prayer, guys. All right. Dear Heavenly Father, I just want to thank you so much, Lord, for always giving us the opportunity here to teach our students, Lord. I ask you to continue to guide us with confidence, with patience, and with discipline, Lord, and giving our students the ability to apply everything they learn on a day-to-day basis. We know that we are on a day-to-day journey, and a lot of people they base their progress based off of what they do on a daily thing, but we know that trading and just our journey with you is more of a long-term thing. So I just ask you to help everyone look out on the higher time frame and understand that this is a long-term thing, right? So give us the consistency to be able to trade these markets and to be able to understand this better, to show our students as well. We're all on the same path, Lord, and we may be on different times in our path, but we know that everything is aligned and your will be done. In Jesus' name I pray. Amen. Hello. Great class, guys.
Amen.
Great class. Always a great class with our
Bye.
capital. Come on now. Let's get it, guys.
Man.
Amazing. W's in the chat for the chat. Hello.